On the 23rd of June, the great British public defied the bookies' odds and stunned the pollsters by voting to leave the European Union. Sterling collapsed in the immediate aftermath of the vote, which was expected, while the FTSE was gripped by uncertainty and volatility. But what does this all mean for savers and investors? Hi, I'm Tom Selby, Senior Analyst at AJ Bell. In these turbulent times, it's important not to make any panic decisions based on speculation or rumour. The political and economic landscape may be febrile, but any attempt at saving or investing based on crystal ball gazing is fraught with risk. So, in the short term, the message is simple. Keep calm and carry on. But what are the big personal finance issues investors should be aware of as we go through this period of difficulty? The government has confirmed, first of all, that there will be no emergency punishment budget, so any spending cuts or tax rises will probably take place in the planned autumn statement following a Conservative leadership election. This is likely to be a stay of execution though, rather than a full-on reprieve. If the economic warnings of the likes of the Treasury and the Bank of England and others are proved correct, the next Prime Minister and his or her Chancellor will eventually need to wield the axe or raise taxes to balance the books. There are a series of options available to the government, but each is going to be pretty difficult for them to implement. For example, they could cut high-rate pensions tax relief or remove the state pension triple lock and raise billions of pounds, but that would risk angering core Conservative voters. They could also increase taxes on those in work, but that would add insult to injury for younger generations, many of whom voted to remain in the EU. Recent forms to death benefits for pensions, which allow you to pass on pensions tax-free when you die before age 75, may also look a bit generous in this context, and with us moving into an era of renewed austerity. Either way, it's worth considering make the most of the tax incentives that are available from the government at the moment while you still can. And what about investing for your retirement? How's that affected by what's going on? Well, whether you're 20 years from taking your money out of your pension or you've already started drawing it down, the outcome of the referendum shouldn't be the only factor you consider when you're investing your money. We've seen gilt rates fall on the back of the result, depressing annuity rates and placing a strain on investors searching for yield. But, and I know this might sound boring, you should remain focused on your retirement income goals and how much risk you are willing to take in order to achieve them, rather than getting sucked into second-guessing the market. Ultimately, everyone will eventually have to start looking at what really drives company valuations: profits and cash flow growth, which in turn are the result of the broader economic backdrop, as well as the competitive position, financial strength and management skill on offer from individual firms. Market volatility driven by sentiment rather than company fundamentals, as we talked about earlier, is normally short term, and people should not panic or get overexcited by what's going on around them. We'll endeavour to keep you abreast of all the key personal finance developments during this period of volatility and uncertainty. But in the meantime, stay cool and focus on your long-term goals. Thanks for watching, and I'll see you again next time.